Okay, so welcome everybody. I'm Chris Newberry with the Life Team at the brokerage. So delighted to have you join us this morning. Got a great presentation. I think you're really going to love. We get asked about Social Security daily, if not weekly, and there's very few people that have all the answers. We're lucky to have Jody on with us today that has all the answers. So we're excited to have him shed some light on an important topic and answer some of those questions. We could not have a speaker like Jody without a sponsorship of one of our carrier partners. Protective Life is sponsoring our presentation today. And Amanda, thank you so much for doing that. And with that, to help present, introduce our speaker and moderate our Q&A, let me introduce our good friend, Vice President of Protective, Amanda Fleskoski. Morning, Amanda.
Good morning. Thank you for the introduction, Chris, and welcome everyone to today's presentation. I'm going to take just a couple of minutes to introduce a good friend of mine, Mr. Jody Harris. He was with the Social Security Administration for 34 years before coming over to Protective Life and being our Social Security consultant, if you will. And I will let you know that at retirement, Jody held the title of Public Affairs Specialist for the state of Alabama, which means he was responsible for the Social Security Administration education and outreach programs across the entire state of Alabama. So if there's a guy that's qualified to educate us a little bit on Social Security, Jody is the one. So that being said, he now is a Social Security consultant professionally, and he helps to educate financial advisors and insurance specialists like yourself. We're going to be covering today what to expect from Social Security, also how to obtain the Social Security benefits. And of course, we're all looking to identify sales opportunities in the life insurance and the annuity space. So we are going to hit on that. But keep in mind, as Jody is going through his presentation today, I want you to think about your clients. And the demographic I want you to think about is individuals between the ages of 55 and 65 that have not yet started their Social Security. That's who we're really trying to identify. So keep that in mind as we get going here. And without further ado, I am going to turn this over to Mr. Jody Harris.
All right. Thank you, Amanda. Thank you, Chris. And good morning. And we're going to try to learn about Social Security today. Social Security is going to be important to almost everybody you touch. And one of the very common questions I get asked is, what is the biggest mistake you see individuals make concerning Social Security? I think the biggest mistake individuals make concerning Social Security is they look at Social Security and make an emotional decision about their benefits rather than a good financial decision. Social Security is a significant asset, and the benefits could be more than you expect, maybe. Or for some people, not as much as they expect because they have unrealistic expectations. But the people ask now, well, how much can I get? You know, I paid a lot of taxes. How much can I get from Social Security? I'm going to give you a good government answer. It depends. It depends on what you earned and paid Social Security taxes on in your working career and when you start payments. But the average Social Security retirement payment is $1,827 per month. So the average person gets about $22,000 a year from Social Security. Of course, some of you, you're not going to deal with average people. You're going to deal with people like my friend Sam here. Sam's been a lifetime high wage earner. So he is eligible for the maximum Social Security payment for someone starting benefits in 2023, $3,627 per month. Sam's wife, Sue, has been a stay-at-home spouse. She never worked outside the home. She managed the household. She is eligible for an amount equal to half of his, $1,813. So between the two of them, they are eligible for $65,000 a year from Social Security. That's the same as having $1 million asset. So that's why I think it's very important that you look at Social Security just like you do your other assets. Some of the issues you're going to face. Everybody's going to talk to someone who says, well, I don't even know why we're having this conversation. It's not going to be there. I'll never get a check. I don't even understand this. Congress stole all the money. I don't get it. And they say this because they don't understand the program. They don't understand how it's financed. They don't understand the key decisions they need to be prepared to make. And they don't understand the consequences of those decisions. So we're going to work on this today so you can help your clients make good financial decisions about Social Security. First thing is, let's make sure you understand what Social Security is, or more importantly, what it is not. Social Security is not your retirement plan. It's not a savings plan. It's not an investment program. Social Security, from the beginning, has always been set up the same way. Social Security is a pay-as-you-go system that transfers money between generations. The Social Security taxes that you're paying in June, that FICA tax that you pay off your wages and self-employment, that money is immediately going out in payments in July to your parents and grandparents. So the money moves immediately from the working generation back to the retired generation. And that's the way it's worked since the program was founded in 1935. First payments went out in 1937. It's always been a pay-as-you-go system, but in 1937, the rules were a little different than they are today. In 1937, you only paid the retired worker. You did not pay anyone else. There were no benefits for a spouse. There were no benefits to divorced individuals. There were no benefits to children. There was nothing paid for a survivor, and there was not a disability program. You paid the retired worker only in 1937, and they had to be 65 years old. There was not an early retirement option in 1937. So you paid the retired worker only at 65. Life expectancy in 1937 was only 63. So it was a really strong program back then because everybody pays in, and most of them died before they ever received a payment. And the ones that did get a payment got it for just 2 or 3 years. You fast forward to today, it's not as good a system today as it was in 1937. And several things have happened. One, you're paying a lot of additional people. You're paying benefits today to a spouse. You're paying divorced spouses. You're paying widows, divorced widows. You're paying disability benefits. You're paying children. So you're paying a lot of additional people. But a couple of demographic issues have hit the programs hard. The first one's kind of my fault. My generation, us baby boomers, we didn't have enough children. We didn't put enough kids back in the front end. If you'll think back, look at your history books, in the 50s and 60s, when I was growing up, you look around my neighborhood, and all the families had 2, 3, and 4 children. You look around my neighborhood today, and all the families have none, 1, and 2. So my generation did not put enough children back in the front end. But the most significant thing that happened was my parents' responsibility. My parents did not cooperate by dying. They lived too long. They didn't live 2 or 3 years in retirement and die. They live 2 and 3 decades. All of you are aware that life expectancy is moving out. Average life expectancy today is 85, not 63. And a great example of this, my father-in-law died last year. He was 91 years old. He drew Social Security benefits almost 30 years. If you're a married couple today, there's a 1 in 3, and you're both 65, there's a 1 in 3 chance that one of you will live past 90. So you need to approach Social Security different than what your parents and grandparents did because your circumstances are different. When Social Security started, there were about 40 people paying taxes for every person that received a payment. Today, there's 2.8 people paying taxes for everyone that received a payment. And by 2034, so in 10 years, there's only going to be about 2 people paying taxes for everyone that gets a payment. So that leads us to the drama. Social Security is broke. It's bankrupt. It's insolvent. You all saw the news articles that came out at the end of March when Social Security's annual report came out. The trustees do a report every year projecting the future. The current report states that if Congress does nothing in the next 10 years, in late 2034, early 2035, Social Security will not have adequate resources to pay all of the promised benefits. At that time, if Congress does nothing, everyone across the board will take a 20% cut in benefits. Notice what I did not say. I did not say checks will stop. I said payments will be reduced. The current law states that payments across the board will be reduced to everyone if there's not adequate resources to pay payments in full. So the current projections are in 10 years, that's what will happen. Now, realistically, I don't think there's any chance of that. Social Security has been at this point twice in the 88-year history of the program, and both times Congress took action to put additional resources in. The last time this happened was in 1983. Benefits were scheduled to be reduced in the summer of 1983. In April of 1983, Congress amended the Social Security laws to put additional resources into the program. So I fully expect that to happen again, but I also realize in the political world, a problem that is 10 years in the future doesn't have a sense of urgency at this moment in time. So we'll just have to wait and see what Congress is going to do. Because we've started the election cycle now, I'm not real comfortable saying anything will happen in the next 2 years, but we'll just have to wait and see. So how do you help your clients prepare for retirement in today's environment? When you get ready to move into retirement, and some of you are already considering this, you're going to have Social Security benefits. Some of you will have a pension, either a defined benefit plan, defined contribution plan. You'll have savings and investments. You'll have insurance. You'll have annuities. You may still be working. You may have resources coming from a variety of areas as you move into your retirement period. But we're going to focus on Social Security benefits today. So first thing, how do you know what to expect from Social Security? Well, you look at your Social Security statement. You can go to SSA.gov or socialsecurity.gov, click on My Account, answer a couple of questions, and you can download your Social Security statement immediately from Social Security's webpage. Immediately. You need to look at this statement every year. Encourage all of your clients to pull this statement and look at it. It gives you an idea of what to expect from Social Security, what your survivors could expect if you die. And that way you can make a good financial plan to build on your Social Security benefits. Because Social Security was never intended to be your sole source of retirement income. It was just intended to be that base income that you build your other resources on. So people ask, well, how much can I get? Well, let's talk about your benefits. Let's talk about what you control, what you don't control, and the key financial decisions you need to be prepared to make. First thing, clear up a misconception. Your Social Security payments are based on your highest 35 years of earnings over your entire lifetime. They are not based on high 3, high 5, last 10, or some combination like that. Those are rules for private pensions. Social Security is looking at a snapshot of your earnings over 35 years. To qualify for Social Security retirement benefits, you need 40 credits. Some of you may recall when this used to be called 40 quarters of coverage, but today it's just a credit. It's based on earnings. If you have $1,640 worth of earnings this year, you get 1 credit. You can earn 4 credits a year. So if you have $6,500 worth of earnings, you've got your 4 credits for 2023. Once you have your 40 credits, 10 years worth of work, then Social Security is looking to say, well, what can you get from retirement benefits? You are now eligible. Social Security looks at your highest 35 years of work over your entire lifetime. But to benefit you, they don't use actual wages for most of those 35 years. Social Security takes all the earnings each individual year that you had prior to age 60 and indexes those dollars up to what a dollar's worth the year you turn 60. Everything from 60 forward will be actual dollars, but anything before age 60 will be a pretend dollar. Now, I'll give you an example of how that would work. Say in 1975, you earned $10,000. That was fair money in 1975 at poverty level today. When your benefits were determined this year, you received credit for a little over $63,000 for 1975 because that's the value of that $10,000 today, and you're retiring today. You're not retiring 40 years ago. So Social Security takes all of your earnings before age 60, indexes those up to current values. Everything from 60 forward is actual values. Then you pick the highest 35 out of that group of numbers, add them all together, divided by 420. Now, 420 is the number of months in 35 years. So that gives you your average monthly indexed earnings. That goes into a benefit formula, and that gives you your Social Security benefit payment at your full retirement age. So what's this full retirement age stuff? Well, again, it depends on when you were born. You're all aware that Social Security's retirement age is moving up to 67. And that has caused some confusion in the senior population, particularly as it relates to Medicare, because the Medicare age did not change. And I know individuals that have missed some Medicare opportunities or missed some coverage dates because they did not sign up for Medicare at 65. They thought they had to wait till later. So just be aware of that there's 2 different significant dates. But today, everyone born 1960 or later, their full retirement age is 67. So all of those individuals are 63 years old now. And so today we're going to talk as though everybody's full retirement age is 67. The importance of this, if you wait until your full retirement age to start your Social Security payments, you get your full benefit. You get it all. You can start Social Security retirement benefits as early as 62 if you choose, but then your benefits are reduced. They are reduced a fraction of a percent for every month you take a payment prior to your full retirement age. Every individual month matters. The closer you get to 67 before you start payments, the smaller the penalty. You can also grow your Social Security retirement benefits if you delay payment after full retirement age. You can delay up to 70 and get a bonus. The bonus is 2/3 of 1% per month, works out to 8% per year. So for our 67-year-old today, worst case numbers and best case numbers, if they start at 62, they are taking a 30% cut in benefits, 30%. Conversely, if they delay starting payments to 70, they're getting a 24% bonus. And this is the key financial decision you need to make. You can't control what you worked and earned over your lifetime, but you can control when you start payments. You can change your payment 76% based on the decision you make. 76%. So the golden rule with Social Security, the longer you wait, the more you get. The longer you wait, the more you get. Important rule number 2, you must be present to win. So people need to decide what works best for them. So they're going to ask you, what should I do? What should I do? Well, maybe some things they think about. First thing, this is going to be an individual decision. Everybody's going to have different circumstances, so you all may make a different decision. Social Security employees do not provide financial guidance. So you need to know what you want to do before you contact Social Security. So maybe some things you think about. How's your health? What's your longevity? Does your family die at 75? Does your family die at 95? Are you still working? If so, how much are you earning? Are there other people that can get payment off of your record? Can you get payment somewhere else? A lot of things to consider. But the answer to what's the right decision is pretty straightforward. You should do what is best for you. You should do what is best for you. So now you've decided it's time to file for benefits. When you file your retirement claim, you can file online. You can do it over the phone with a telephone appointment, or you can go into an office. You can do that for any type of benefit except survivor benefits. Survivor benefits you cannot do online. But when you get ready to file for benefits, you will be asked a series of questions to help identify, are there other people that can receive payment off of your record, or could you maybe get a payment somewhere else? First question you're going to be asked, are you married? Social Security is looking to see, is there a current spouse? Your current spouse, if they wait to their own full retirement age to file for anything, could receive an amount equal to 1/2 of your full retirement amount. Notice carefully what I said, or more importantly, what I did not say. I did not say your spouse gets half of your benefit. You get yours regardless. This is an additional amount due your current spouse. Your current spouse can start payments as early as 62 if they choose. But of course, there's a penalty for starting before their full retirement age. At 62, they would only get 32.5% of your amount. The only way they get that 50% is if they wait to their own full retirement age to file for anything. Then there's some rules. The first and most important one, your current spouse cannot file for anything off of your record until you file your own retirement claim. You must start yours for them to get anything from you. When they file for spouse benefits, they must file their own retirement claim at the same time. They get the larger of the two, not both, and they no longer have the option to start the spouse payments and defer their own retirement benefit. So your current spouse cannot get benefits until you file your own retirement benefit payment. When they file for spouse payments, they must file their own retirement claim at the same time. They get the larger of the two. And if they start any payment, either retirement or spouse, before their full retirement age, they're locking in a permanent reduction. Next question you're going to be asked, have you ever been married before? Yes or no? If yes, how did that marriage end? Well, there's two obvious choices here. It ended in death or divorce. We're going to talk about divorce first because that happens a lot. Death generally is a one-shot deal. If you are married to a person for 10 years or more and divorce them, they are eligible for divorce spouse benefits off of your record, and you are eligible for divorce spouse benefits off of their record. The divorced spouse gets the same payments that the actual spouse could receive. So if they wait until their own full retirement age to start payments, they can get 50% of your full retirement amount equal to 50% of your full retirement amount. They start payments early. They can start as early as 62, but they get 32.5% then because there's always a penalty for starting early. Some rules for your former spouse. We've already covered the most important one. The marriage must have lasted 10 years or more. If it's less than 10 years, they get nothing. They must also not currently be married. Then your former spouse has a filing opportunity that's not available to anyone else. Remember, I told you that your current spouse could not get benefits until you started yours, where your ex can. So if you are at least 62, where you could file a retirement claim, whether you do or don't, and they are at least 62, they can file for benefits off of your record. Now, it's important to be aware that payments made to your former spouse have no impact on anything paid to you, nor do they impact anything paid to your current spouse. Again, when they file for divorce spouse payments, they must file their own retirement claim at the same time. They get the larger of the two, not both. And if they are currently married, they're not eligible for divorce spouse benefits. So they have to be 62 or older and not married after being married to you for at least 10 years to file for divorce spouse benefits. You'll also be asked, do you have any children? If you have children under 18, they are due benefits once you start your retirement payments. And do you have a child with a disability? If you have a child with a disability, they have some unique rules. A child with a disability is eligible for benefits as long as the disability started before that child was 22 years old and that child has never married. It does not matter how old the disabled child is today. as long as the disability started before they were 22 years old and they have never married. Then people say, well, what if I die? Well, Social Security pays survivor benefits. A good number of people receive survivor benefits under Social Security. Excuse me. Your widow, widower, divorced widow, they all get the same thing. A widow, if they wait until their own full retirement age to file for survivor benefits, is eligible for an amount equal to 100% of what the deceased individual would have been due if they were alive that day. Now that's government speak. So I'm going to tell you in English what I just told you. When you get ready to file your own retirement claim, you're making a decision about what you will receive today and what your surviving spouse will receive tomorrow. Your widow can get no more than you would have gotten had you continued to live. So when you file your retirement claim, if you elect to start your retirement payment before your full retirement age, so you're taking a reduced retirement check, you signed up somewhere between 62 and full retirement age, you're capping what your survivor can get. They can get no more than you would have gotten had you continued to live and you were receiving a reduced payment. Conversely, your widow can get that bonus you earn by delaying your payments after full retirement age up to age 70 if you want to, that 8% per year. So when you get ready to file your own retirement claim, you're making a decision about what you will receive today and what your survivor will receive tomorrow. So it's important to think about that. A widow can start payments as early as age 60, but there's a penalty, of course, for starting early, 28.5% cut. They only get 71.5% of your amount at 60. Again, the closer they get to their full retirement age before they start those payments, the smaller the penalty. A widow can get benefits at 50 if they're disabled, again with that 28.5% cut. They can get benefits at any age if they have a child under 16 or a disabled child in their care. And the important thing here, if you're dealing with a widow that is under age 60, no one is disabled, and there's no children involved, there are no Social Security benefits due that person. You need to have a plan to fill that revenue gap if you have a death of a younger person. I spoke to a person a couple of weeks ago at a seminar. She was a widow. She was 38 years old with no children. She was not disabled. There were no Social Security benefits available for her until she was 60. Her husband died unexpectedly. She said, fortunately, he was appropriately insured, so she has adequate resources, but she could have been in serious financial stress if he had not made arrangements to have appropriate insurance. A divorced widow or regular widow can remarry and keep the benefits as long as they remarry after age 60. Remember, I told you that while you're alive, your divorced spouse, if they remarry, they get nothing from you. They have to be unmarried, where your widow or divorced widow can keep the survivor benefits as long as they remarry after 60. They remarry before 60, they lose the benefits. So you need to make sure people understand the importance of that 60th birthday. Then a widow has a filing strategy that is available for them that is not available for anyone else. Survivor benefits are a death payment, where your own retirement benefit is a life payment. You can always start one and defer the other one to later. So you can start the survivor benefits as early as 60 and wait on the retirement benefits to 70 if it's more, or you can do just the opposite. So you need to look at both of these numbers. You'll be asked if you have any children. If they're children, they are due survivor benefits too, up until 18, or if they're a disabled child, they can get benefits the rest of their life. Now, some things that impact benefits. The first and most common one is work and employment. Two scenarios. If you're receiving any Social Security payment and you have not reached your full retirement age, there are reductions based on your earned income from employment. You make over $21,240, you will lose $1 in Social Security benefits for every $2 you go over. Once you reach your full retirement age, there are no restrictions at all on their Social Security payments. The work restrictions only apply under full retirement age. And the only thing that counts in that $21,240 is earned income from employment, income that you pay FICA taxes on. And speaking of taxes, many of the folks you run into will owe federal income tax on a portion of their Social Security benefits received. And you're looking at provisional income. It's all their income from wages, pensions, self-employment, investments, basically your adjusted gross off your federal income tax, plus any non-reported income like municipal bonds, plus any other exclusions, foreign work, whatever, plus half your Social Security payments, plus half your spouse's Social Security payments. Depends on what bracket you fall into. But if you're filing joint and it's higher than $32,000 a year, or single at $25,000, then you owe federal income tax on a portion of your Social Security benefits. If your income is higher than $44,000 for joint or $34,000 for single, then you owe federal income tax on 85% of your Social Security payments. Is taxed as ordinary income in whatever tax bracket you fall into. All right, I'm gonna skip this because I don't need it. We don't need that. We don't need that. We don't need that. We don't need that. So now, Amanda and Chris, let's do some questions. We got some time left, and we'll answer as many questions as we can.
First question for you, Jody, is, and I think you did go over this, but if there is a married couple and they're both receiving Social Security benefits and one of them passes away, does the remaining individual get to keep both incomes, both Social Security incomes?
No, and this was a very difficult conversation I had with a cousin. I'm eating dinner with her after her husband died, and she said, well, I'm going to be fine. I get his Social Security payment and mine. I said, oh, no, you misunderstood. You get the larger of the two. So the simplest way to explain this to a couple, if you have a couple and they're both receiving a Social Security payment, when one of them dies, the smaller payment goes away, the larger payment continues. So my cousin would continue to get her husband's Social Security payment as a survivor, but because that was higher than her own retirement payment, her retirement payment stopped. You need to have a plan to replace that income, because most individuals' household expenses do not drop that much.
Thank you, Jody. And I will reiterate that, being from Protective Life, guess what? We have life insurance products, and that is a great way for you to help your clients prepare for exactly that situation that Jody just talked about, because they will lose one Social Security income.
She sat there, she was in tears at dinner.
Yep. And Social Security, let me tell you, correct me if I'm wrong, Jody, but they are serious. If they've accidentally paid two of those incomes and then realized one of the spouses has passed away, Social Security is coming after those dollars. They're going to get their money back. So it is so important for you to have a conversation with your clients to make sure they understand how this works, because life insurance is a great way to make sure those families have income replacement. And actually, something unique that Protective has, we have a way, believe it or not, to mimic income as a death benefit. So it's a life insurance plan, but it can be set up to either pay the beneficiary of the life insurance plan a monthly income or an annual income. So get this, right? Jody, you said the average Social Security is $22,000 a year. So your clients could have a $110,000 life insurance policy that pays out $22,000 a year and make sure that their spouse or the remaining individual is going to have a replacement of income. In this case, it would be for 5 years. So there's a lot of options that you can do for your clients, but it's very, very much a conversation that you most definitely need to have. All right, Jody, I'm going to go back to the very beginning. So if you can answer a few of these for us here. We said that, there was a little bit of confusion as to what happens when you're taking into consideration income over the last, 35 highest years of our income. You kind of talked about how all of that worked, but someone said, I'm confused by the income prior to 60 being indexed and then beginning at age 64, it's the actual earnings. So what happens?
Age 60, I'm sorry, either I misspoke or you misheard me. At age 60, it is the actual earnings. Everything before age 60 is indexed. Anything you earn to age 60 forward will be actual dollars.
Someone asked, are you going to be going into WEP, W-E-P, or TRS implications? I don't think you spoke about either of those. I don't even know what they are. Right at the end.
I can do it real quick if you want me to. If you deal with government employees that work for government agencies that did not participate in Social Security, they don't have the FICA tax withheld from their wages. There are two provisions that impact them, and that TRS group is one of them. Well, the first one is bad, really bad. And the second one is just awful. So there's not a good one. So the first one is windfall elimination. You'll see it abbreviated as WEP. That's for individuals that worked at least 10 years under Social Security. So they qualify for Social Security retirement payments, and they qualify for a government pension from an agency where they did not participate in Social Security. That Social Security retirement payment is reduced up to $557 a month, but they still get something off their Social Security record. That's the bad one. The awful one is government pension offset, GPO. That's for the same person. They work for a government agency that qualify for a pension, and they want to file for Social Security benefits as a spouse, that 50% share, or as a survivor, that 100% share off of the Social Security record of another individual. That spousal payment is figured just like normal, 50%. The survivor payment, 100%, just like normal. Then Social Security takes 2/3 of their monthly government pension and subtracts it dollar for dollar from any Social Security benefits due. And frequently it makes that zero. They get nothing. But remember, these two provisions only apply to individuals that work for government agencies, qualify for a pension, and they did not pay Social Security taxes. They paid Social Security taxes while they were working for that agency. They get their full Social Security and their pensions with no offsets.
Perfect. All right. We still have several more here, Jody. We're going to keep you as long as we can. For a married couple, if the younger spouse takes Social Security at 62, the older spouse is still working, not taking Social Security, and then the older spouse does end up taking Social Security later on, can the one that started reevaluate and readjust the amount they're getting?
Yes, they can always move up. But remember, because they took their retirement payment before their full retirement age, they will never get the full 50% share as a spouse. But if they're due additional benefits, they always move up.
Perfect. And when it comes to a disabled child, Jody, so we have a disabled child that's collecting benefits under that parent. What if that disabled child gets married? Will they lose that disability Social Security payment?
Yes.
Perfect. And I know that we talked about the sensitivity of getting married or being married and not being able to collect a benefit. Can you reiterate again the two situations? Because I think it was either divorced or widowed. Can you reiterate real quick if and when they can get married after they started collecting a benefit?
Okay.
Because we have someone here that's confused that if someone gets married, are they going to stop receiving their Social Security benefit?
The simple way I can explain it. If you're a divorced individual and your ex is still alive and you're receiving benefits as a divorced spouse, your ex is still alive. If you remarry, the benefits stop. Period. If you're a divorced individual and your ex is dead, so you're getting survivor payments, or if you're just a regular widow, not divorced, and they're dead, you're getting survivor payments. You can remarry after age 60 with no impact on the benefits. So just think of it this way. I think of it this way. This doesn't sound good, but I think of it this way. If your ex is still alive, Congress is hoping that there'll be reconciliation and you will remarry. If your ex is dead, that option is gone.
Very good to know. All right, here's another one for you. And this is an example here. So this is a situation where the missus, who was a stay-at-home missus, they're 5 years older than the mister who was, actively working. So the missus, 5 years older, stayed at home. She only has 8 credits because she, worked very, very little prior to, getting married. Does she have to wait until that younger spouse hits 62? Or can she start when she's 62 or 65? How does it work when you have the non-working spouse being older? And the other individual is probably still working.
Well, she's not eligible for any retirement benefits on her own because she did not work. So she cannot get any benefits as a spouse off of his record until he files his own retirement claim. The earliest he can file is when he's 62. If she's 5 years older, she will be 67 before she's eligible for any benefits off of his record. If he dies and she is 60 or older, she can file at that time.
And if she, if they did that when he was 62 and she was 67, technically he's younger. So he would be taking that discounted.
He would take a 30% cut. She would get her full spousal share because the reduction is based on the age of the individual receiving the payment, not the family.
Perfect. We have so many questions here. Again, we're going to do as many of these as possible. And here's the thing, guys, if your question doesn't get answered today, you're more than welcome to reach out to your friends at the Brokerage Inc. and send your questions to them. We'll make sure Jody gets those answers for you. Okay, here's a good one. We were talking about this a little bit before we actually rolled into the presentation. Are the people working for Social Security expected to educate and counsel the beneficiary or, the recipient about Social Security and how it all works? Are they educated enough?
No, they do not provide financial guidance. They will answer any question you ask, but they're not when you go into a Social Security office to file for benefits, they're going to just ask you what month do you want your check to start. And they are trained to pay you the most money you're due that month from whatever record gives it to you. So they're not going to, but now they can answer any question you ask, but they're not going to tutor you on Social Security.
Perfect. And when it comes to, and people are having babies later and later in time, right? So if you have a parent that's receiving Social Security benefits and they have a minor child, do the benefits stop once the kids reach the 18 years of age?
Yes. They can get it a few months past 18 if they are a full-time high school student. Social Security no longer pays for kids to go to college.
Perfect. All right, let me see here. I keep rolling in just a second. I'm 64, currently drawing disability. My spouse has reached full retirement and is drawing at this time. Will I be able to change to full Social Security and draw that 50% of that spouse? If so, will I wait until I'm full retirement age?
Okay. Let me talk a second about disability. Your disability payment is determined as though you were full retirement age the day that disability payment began. So ignoring the spousal payment at this point, you will stay on disability till you reach your full retirement age of 67. And at 67, you will automatically convert from disability benefits to retirement benefits, but there will not be a change in your monthly payment amount. If you are 62 or older and your spouse has already filed their own retirement claim, you can file for benefits as a spouse on their record. You said you were 64 now, so you would take reduced spouse benefits. So the only way you would get a spouse payment is if half of what your spouse has received, half of the other person's full retirement amount is more than what you are currently receiving. If it's less, then you are receiving your maximum amount. You get the larger of the two, not both.
Perfect. Thank you, Jody. As a Medicare agent, most of these individuals' clients are 64 years old, and they have no idea that Social Security and Medicare are not tied together. And so this individual is curious. Are you aware, Jody, of any sort of a brochure or anything that really helps to simplify this concept that they're two separate things?
Not really. Social Security, can't remember whether Social Security, I know the Medicare and You booklet goes out to people 3 months before they're 65 when they're enrolling them in Medicare, but I don't know if there's any pamphlets. Medicare might have something. I don't know that Social Security does.
Perfect. Let me see here. I have a client, 67, was still working and receiving benefits, got hurt at work, got laid off, broke a bone in his back. He wants to apply for disability because he thinks he can get more money. Is that possible?
No, he cannot file for disability once he's reached full retirement age. You cannot get disability after full retirement age. He's getting what he can get.
Perfect. Let's see here. Someone was asking about a lump sum option ever. Is it always an income stream form, never a lump sum option?
Never a lump sum.
People want to know if you have a blog or Facebook page where you're going to be talking about professional topics of this nature.
No, I do not.
Jody, thanks a bunch for your time today. Amanda, thank you so much for
Can I say one last thing, Chris?
Yes.
So given that we are all in sales and we're here to help our clients, but at the same time be compensated for the services that we provide, I will reiterate another place where the Social Security conversation does lead to a sale, right? We talked about the life insurance sale, but really you guys saw, I think Jody called it the golden rule, right? The longer you can wait, the more benefit you get. So part of the strategy behind this is to really understand what other assets your clients have, whether that's bank accounts, what other assets do they have to live on, and can they live on those now in order to delay receiving their Social Security benefit to 70, for instance, right? So that they then can receive the greater benefit from Social Security. So there's several different products available to you guys. There's annuities that you can take someone's other assets and put them into the annuities to start an immediate income stream again now, in order to spin down other assets now in order to delay taking Social Security. So as you guys can see, there is some strategy behind all of this that you can help your clients with. So I am done. I will, again, I appreciate everyone jumping on this call. And again, hopefully we will do a second one, but I'll turn it back over to you, Chris. And thank you again for the opportunity.
Thanks so much. We have more coming up at the brokerage, so stay tuned for more.